right, guys. Yeah, thanks again for joining us this afternoon. I'm excited to be talking to you guys again. We are diving in this week about current activity in the market, why hedge funds are investing more into multifamily. So people with, millions, if not billions of dollars that are actively seeking and actively investing in multifamily right now, despite some of the headlines they may read, despite high interest rates. We'll be talking about what activity we're tracking in the hedge fund space and large market movers, the market cycle and trends that we're seeing, and some of the sub-market snapshots that we find really interesting. So again, feel free to jump in here on any of these topics, and I'll give it over to Nick to talk about what we're seeing specifically with hedge funds.
Great, thanks, Brian. Yeah, so we'll talk a little bit about what we're seeing for large transaction activity for hedge funds and institutions right now in the multifamily space. So right now, Blackstone's very active. They've got roughly $191 billion to spend. And I think 65 billion of that was allocated specifically for multifamily. And, the COO of Blackstone said back in April in their earnings call, the recovery will not be a straight line, but we're not waiting for the all clear sign to invest. So they're essentially calling the bottom, or they did call the bottom back in April, and they've been deploying capital since then. So going to the next slide here. Blackstone made a move buying Tricon. So Tricon was a single family investment firm, and their acquisition of $3.5 billion, it purchased their future development pipeline, which included over 21,000 single family homes, and also their existing home pipeline in the United States and in Canada. So that's just one bullish move that they made in 2024. And then the next one came only a few months later when Blackstone purchased AIR, Apartment Income REIT, for $10 billion. On the next slide here. Yep. So yeah, they purchased AIR for $10 billion. That included 77 communities, over 27,000 apartment homes, and across 10 states. So definitely a very bullish move on their part, making a large purchase and betting big on multifamily, while a lot of groups are on the sidelines right now. The next slide is just another example. KKR making a similar move here. This was in June. Purchased $2.1 billion of apartments, over 5,200 apartments in California, Texas, and New Jersey, mid-rise and high-rise apartments. So that's a major move for them.
Like, what was that first one? How much was it? How much billion?
AIR was $10 billion.
Yeah, and the one before that was
3.5.
So over 15 billion in just those three transactions. That's crazy.
Yeah. Yep. Happens quick. And then one more example that happened in May was Brookfield buying 1.6 billion, and that's over 7,300 apartments in Florida and Texas. So that's the next slide. And that's over 23 properties that they bought from Starwood. So that's essentially them also calling the bottom. So you got Brookfield, KKR, and Blackstone all making very big bets in the multifamily space, upwards of 15, $16 billion of capital deployed within the first 2 quarters of 2024, specifically for multifamily. And then, on the next slide here, we'll talk a little bit about this, but institutions are definitely flocking more towards single family homes, single family rentals, single family homes. So historically, over the past 8 years or so, they haven't really been very active from that period of 2012 to 2020. The institutional investor in the single family home space wasn't incredibly active, and then we saw a spike after COVID, and then also coinciding with the interest rate hikes, where institutional buyers and hedge funds started buying up swaths of single family homes. Now that percentage of total ownership isn't as alarming as some headlines might assume, but they definitely have increased their total deployment of capital for single family homes. So they're very bullish on those as well.
I think sorry, Nick, just to take a little step back, I think we jumped into this too quick. We didn't even quite mention who we are, and for those of you that are new and why we're even talking about this. So we're Elevate Commercial Investment Group, and we acquire multifamily apartments. We own over 5,000 units. We've acquired a little bit over 7,000. So we've had quite a bit of exits there, and we're continuing to acquire more multifamily. The reason we like to follow the REITs and these large private equity firms is because they spend a ton of money on research and looking at the different markets, and we like to follow the money. So, there was a time there where last year where the transaction volume was very minimal and these larger groups weren't making moves yet. But, now going through what Nick just went through, you can see the kind of moves they're making. Some of the things they're saying where they think we're at the bottom or at least near it, where they feel comfortable enough to start making these large transactions. So definitely something like we like to see. I think we're mentioning the single family here because single family has just become so unaffordable that it's just putting more pressure on renting, whether it's single family homes or the apartments, which gives us just more, signs that we're in what I think is the greatest real estate asset, which is multifamily. Sorry, so just wanted to kind of give everybody that background. I'll let you keep going through this, Nick.
Yeah, no, that's helpful. Yeah, it's essentially we're talking about this to kind of paint a picture why we're actively looking for deals, and why we're trying to put stuff under contract right now. And these big guys are moving and making plays. So we're, like George said, we're following that money and trying to make smart bets as well. This is just one more slide, just highlighting how tier 4 investors, meaning essentially institutions with 1,000+ properties, have increased their single family acquisition capacity in the past few years. So they've definitely been increasing their interest in that asset class. Next, this is generally how institutions, large private equity firms are going to be underwriting their acquisitions. And this is just one through talking with large check writers and, listening to earnings calls, listening to, the large players in the space talk about this stuff. But essentially they're looking for good markets with strong demand. the basic population growth, job growth, demographics, and low crime. They're trying to make deals work on a return basis without a drastic V-shaped recovery in the multifamily space. There's definitely a lag in certain submarkets and markets in the multifamily space right now. So they're placing their bets in the pockets that have strong demand and that won't really require a massive change in market recovery in order for them to hit their low teen IRR returns that they're going to pencil to. And really, as far as replacement cost and sale comps, they're trying to buy probably 20 to maybe 30% below the peaks. They're not trying to get absolute home run deals, I'd say right now. They're trying to deploy really large amounts of capital and get probably low teen to mid-teen IRRs. And not get too crazy on business plans and stuff like that, crazy heavy lifts on value add stuff. They're really trying to buy the best product in the best market and not wait for the rest of the players to come and capital to come and start buying as well, because that increases competition.
Yeah, I think that's interesting here, and it kind of points to our next topic here on like what cycle are we in the current market? Right now, some headlines are saying this will be the best buying opportunity of your lifetime. I think I've been hearing that since December of last year, actually, or even before December of last year. But yet we see these billion-dollar companies with a lot more money and probably a lot smarter than myself and some of the people that are posting, these comments about that. So I think it's really interesting to see these comments about buying opportunities, what we're seeing in the market, making offers every single week, what we're seeing from these institutions that are spending millions and billions of dollars, as we just shown, trying to put a finger on where we are at in the market. So I'll let you kind of take that over here.
As far as the market cycle, I mean, just looking at the data, we're definitely past the demand supply equilibrium point. We're no longer seeing a increase in permits and groundbreaking. So that's on the development front. So we're past the point of equilibrium. We're probably in phase 3, late phase 3, maybe inching towards phase 4. We've definitely seen an increase in vacancy. Rent growth has slowed in certain markets and gone negative in some markets. And we'll talk about this a bit more, but rent growth has actually gone up in certain quieter Midwest markets. So, I mean, all this stuff is very market selective, but as a general, as a whole, we're in the market cycle where it's, we're past the, everyone's breaking ground on new construction, and it's the best time to build and it's the best time to sell. We're past that point in the market for sure. I don't think we've really entered into a economic recession per se, but it's definitely there's a lag in the commercial real estate space where the bid-ask spread is really high still, so the transaction activity has slowed down, and that's the next slide. So we're inching towards that point where stuff's going to start picking back up pretty quickly, I think.
Yeah, I would say it's safe to say that we've already had this huge drop off. I think where if you're asking economists, if you're asking these billion-dollar funds, if you're asking, guys with 5,000 units like ourselves, it's more about where actually are we here in phase 4 or phase 3. Like we've had this huge drop off. Now it's trying to figure out exactly where we're at right here. What are we already past? Are we in the middle of phase 4, beginning of phase 4, end of phase 3? I think that's probably generally where we think we're at right now.
And the problem with that is by the time you realize you're in the bottom, it's too late. Like the bottom was back there.
Yeah,
So, knowing that we're in that phase four somewhere, that's the time to buy.
Yeah,
exactly.
and that again, back to where we started this whole conversation. If you ask Blackstone, KKR, and Air, they would say, "Yeah, we're right here, phase four." And that's how we are looking at deals right now in that kind of institutional lens that we kind of talked about right here, how they are underwriting, not counting on this kind of growth, but really underwriting it right here.
Yep, exactly. So yeah, this is a slide talking about transaction activity. So, it's safe to say there's not a lot of deals getting done right now on a deal by deal basis. There's portfolio deals getting done, obviously, like we pointed out, on the hedge funds and private equity firms with billions of dollars of capital. But on a deal by deal basis, transaction activity has essentially come to a halt here, in most markets. So yeah, the peak was roughly around the summer of 2022, and we have dropped off quite significantly since then.
Yeah, I hadn't seen this chart. This is crazy. I didn't realize we're down to what, 2013 numbers? Is that kind of what it's saying?
Yeah, around 2013 numbers. Yep.
Wow.
Yeah, the spike in 2022 really puts things into perspective, how much
Yeah, so you could say like that's over here, right? 2022.
So yeah, deliveries would be the next thing we can talk about here. Deliveries is essentially uh, new apartments that are coming online and ready to be rented. So it's not ground breaks, it's not permits, it's actually deliveries, meaning apartments that you can, you know, go and rent today, that are newly built apartments. So this trend is showing that in the first half of 2024, there was still a large amount of apartments delivered, 284,000 apartments delivered in the first half of 2024 alone. And then the annual average for the US is that green line right there. So you can see from the peak of 2023 deliveries, we're down quite a bit. The peak of 23 was around 400 and call it 430,000 units, and we're down to 284 in the first half year. So we're down quite a bit, and that's that's a factor of less ground breaks, less development activity, less new construction, etc. And I think that trend's just only going to continue as construction costs have stayed pretty sticky and high. Interest rates and the cost to actually borrow money is still very high.
Well,
Uh,
yeah, I think to kind of paint this picture is your average apartment takes, say, 2 years to build, right? So 2020, 2021, 2022, market was still hot. Everybody was wanting to build more, build more. So that's why you still see quite a bit being delivered, even though it's less. What's really going to be telling, if you were to see the same chart and it had 2025 and 2026, you're going to see a huge drop
Yeah,
compared.
we've got some forecasted deliveries in here in DFW and a couple Midwest markets, but and
Okay.
you're exactly right. It's going to drop off quite a bit, which is why we think we're in that uh, phase three, phase four um, part of the cycle. So let's see. Yeah, so rent growth and supply. So I
There's a
found this.
lot happening here.
Yeah, I found there's a lot happening here. I found it pretty interesting though, if you take a minute to actually digest what's going on here. But This is just a June 2024 snapshot of rent growth and supply from RealPage. And it's basically just telling us in the markets that experienced low or moderate supply during this last, development phase that we experienced, those markets, the Midwest and the Northeast, are actually experiencing rent growth. So your Wichitas, your Lincoln, Nebraskas, your Kansas Cities, your Omahas, Lexington, Syracuse, Cleveland, etc. Those are actually, experiencing some decent rent growth because they weren't overbuilt based on the demand that they were already experiencing. Now, your Sunbelt markets that are easier to build in, there's less red tape, and a lot of actual apartments were built in the past, 2022 to 2023 period. Those were also experiencing population growth and demand, but not to the extent that supply, the supply totally outweighed the demand there. So that's why these apartments are seeing rent decreases, and the majority, like your Austin, let's see, Daytona Beach, Myrtle Beach, Tampa, those are getting hit pretty hard on rent decreases. I think over the long haul, there's good population growth in a lot of these pockets, and they're gonna recover. But right now, rent is flat or negative in a lot of the Sun Belt and higher supply markets that were hit pretty hard. So there's a weird dichotomy of looking at these markets while, as a whole, looking at the more macro charts we were talking about, rent growth is pretty flat, but when you get really specific and more sub-market selective, you can actually pick out some really good pockets to focus on, which is why we're bullish on Kansas City, which is why we're bullish on certain deals and in certain Sunbelt markets as well, because then you can get better buys because there might be some more distressed activity in the low rent growth markets. So all this stuff really is just telling the story of how we're looking at deals and why we're looking at deals a specific way. So this next slide, just diving in a little bit more on development activity. New permits and ground breaks essentially have plunged everywhere. So at the top is a 0%. That's, if there was no change in development activity, and then everything else is a decrease in development activity. So, the big ones here are San Antonio down 70%, Jacksonville down 50%, Houston down 60%, Tampa, Fort Lauderdale. I think Dallas is on here. Yeah, Dallas is on here, 45% or so. So just a huge drop off in peak development activity to current development activity, which tells us that future supply is going to be and future deliveries are going to be lower than the past few years. And then the next chart here is essentially just showing a similar thing, just how the downward trend on multifamily starts is shaping out from the 2022 peak to where we're at now in 2024. So it's just another way to kind of paint the picture with a different graph. Following a bunch of people on LinkedIn, Jay Parsons has some pretty good takes. It's essentially what we just spoke about here. Although he's talking about more on the demand front, while supply is future supply is going to fall off quite a bit because the construction starts have decreased and permits have decreased. we don't think, and he's saying here that demand is still really strong, meaning absorption for apartments is still really strong. And there's a number of reasons for that. Your your typical renter can't afford a down payment on a home right now. Home prices are still very high. Interest rates are still very high. Sellers want to sell at peak pricing, and renters need a place to live. So absorption is actually very strong right now, and it's anticipated to be very strong in the near term. So this next slide paints a pretty good picture. Apartment demand being very strong in 2024 so far. At the low point in 2022, where absorption was lower, it's been picking up quite a bit since then. It's actually outpacing the absorption in most years except for 2021. So we're reaching a very strong absorption period where a lot of these new deliveries are getting occupied, maybe at a slower pace than anticipated, but there's still demand for a lot of the stuff, especially in Texas, because of the population growth, job growth, and overall economic drivers. So, it's always, all the stuff is very market specific, but as a macro, the multifamily space has very strong demand right now, from a resident perspective.
What I see looking at all this is we're gonna have this time right now where these units are getting absorbed. Some markets are gonna fare better than others, but the supply is not gonna be there in 2025, 2026, which is telling us that there's gonna be rent growth. Right now, yeah, we're seeing some negative and we're seeing some flat. And not that we're putting any ridiculous rent growth in our underwriting or pretty much, I don't know, we're not putting much of anything as far as rent growth, but the numbers tell the story, and most likely we're going to have some decent rent growth in the next few years.
Yeah, exactly. And then this is more Texas specific, since we focus a lot on Texas. A lot of us are based in Texas, although we're looking at deals in other markets as well. Apartment demand in Texas is definitely catching up to the supply wave that hit in 22 and 23. So, and then the next slide is also just a similar graph showing how absorption is picking back up and more in occupancy and rent growth is expected to increase over the next few years, like George said. So, I mean, as a whole, we are in definitely a buyer's market, I'd say. Buyer's market, a buyer's selective market, where we are, making offers on stuff where it makes sense for us, and we're trying to underwrite deals that are not going to need that V-shaped recovery. We'll hit these returns without having a drastic change in the market. It can just be a steady, easy recovery that we're confident that we'll be able to execute our business plan, et cetera. So, I mean, as a whole, we feel pretty good about the multifamily space, and I think the hedge funds deploying billions of dollars of capital do as well. Next few slides here. Yep. Keep going. This is just essentially everything we spoke about, just the topic, status and predictions. So getting a little bit more specific here, we were talking a little bit macro there. We talk about Dallas-Fort Worth as a whole and what we're seeing. So this is just a snapshot of Dallas-Fort Worth. You got over 1 million multifamily units in the Metroplex. As you'll see here, construction activity is down significantly, roughly 32%. Absorption is up significantly. That's simply a matter of more apartments were delivered, more people are moving here, apartments are getting absorbed, demand is still strong. Vacancy is ticking up, and it is up roughly 1.5% from the prior year period. Rent growth has rents have decreased roughly 80 basis points from the prior period. And this is not asset quality specific. So this is looking at A, B, C assets across the board. So the whole multifamily scope. Market sale price per unit down 4%. I think, that's not super helpful of a metric. I think breaking that down into A, B, and C would probably be a little bit more helpful there, but I think your C class stuff is down significantly more than 4%.
Yeah, I was surprised by that one.
Yeah,
What's the prior period? What is
prior period is just 12 months prior to when this was pulled, which is today. So it would be July 2023.
well, I think the issue there is you don't have a lot of transactions either, right? So
Exactly.
what is the comparison to?
Yeah,
Yeah.
not a lot of transaction activity. And that's the next slide here. Market, and then the last point was market cap rates are up a bit. So transaction activity in DFW, I mean, it's completely fallen off a cliff from the peak. You got over $3.5 billion at the peak in late 2021. Roughly 2.5 billion in 2022 peak right there in that quarter. And now we're barely breaking 250,000 or 250 million for this quarter in 2024 for multifamily. So transaction activity in DFW way down in the multifamily space.
That's it. Where did this come from?
This is all just CoStar.
Oh, interesting forecast there on the price per unit. I mean, I'm not doubting that curve. Just I'd be
Yeah, I
curious
mean
to see
it's
how
hard to
they.
say what the forecast is going to be.
Yeah.
I think it's going to go up from here. And who knows how quickly and how high, but it does feel like we're reaching some sort of bottom.
Yep.
So the next slide. So yeah, I mean, transaction activity way down. Next slide talks about rent growth. And this kind of just paints a better snapshot of how rent growth completely spiked in DFW and a lot of markets across the United States in 21 and 2022. Money was pumped into the economy. People had more money to spend. Multifamily rents grew substantially, 10 to 12% in DFW. And since then, rates spiked and rents have come down and come down and come down. And, they went negative a bit. And I'd say they're probably flat or slightly negative right now in DFW. But the forecast, like we were talking about earlier, it's looking pretty promising because you still have a lot of people moving here. You still have really good jobs. And there's just overall strong demand for Dallas-Fort Worth. So I wouldn't be surprised if we see above average rent growth, above 3% rent growth over a few years, as a lot of the supply will get eaten up pretty quickly. And there won't be a lot of new developments delivering as well. So yeah, this is just talking about the supply, as you can see here, the construction under construction falling down quite a bit in DFW, not off a cliff quite yet, but that should keep falling as permit activity has fallen more and more. Future deliveries and demolitions. I wouldn't say this graph is 100% accurate as well. A lot of these forecasted deliveries are probably assuming that developers are able to capitalize deals right now, which it's tough out there to capitalize an acquisition, let alone a development deal. So I
Yeah, that's
would,
what I was gonna mention is even the under construction for 2024, I feel
yeah,
like some of that might just be off of permits and but not
right,
necessarily building the units.
right. So the trend is down on future supply. Who's to say where it's going to end? But right now, it's definitely going down, which is why we're generally bullish on DFW and buying right now because we could probably get some pretty nice rent growth in the if we pencil in a 5 to 7 year hold period on some of these deals. So as a completely different market snapshot, looking at how DFW has performed historically, and it dipped pretty hard there. Like, what does Columbus, Ohio look like? And we're a Midwest, um, quiet Midwest market. Not to say that it's roughly 1 million people live in Columbus, pretty steady population growth each year, nothing too crazy. Their construction activity is also down. Their vacancy is also up. Although two things jump out to me here. Their market rents are up almost 3%, and their market sale price per unit. Honestly, I wouldn't worry too much about the sale price per unit stuff. I'm focusing on the rent growth in Columbus. They're seeing rent growth. There's a different story there versus DFW, where we went negative on rents and currently are around flat/negative right now. They've seen Columbus has seen not as big of a decrease from the peak, and they're now seeing rent growth. So
And you can
that's
almost say the
been,
vacancy is not even, I mean, 0.2%, it's barely moved.
yeah.
And that absorption is crazy, 222%.
Mhm. Yeah. So, I mean, a lot of this stuff, again, it's market specific when talking about multifamily and how multifamily is doing. So this is just looking at two totally different markets, Dallas-Fort Worth and Columbus, Ohio. The next slide here paints a similar story, though. Transaction activity is still down significantly in Columbus. I think that's consistent across almost every market in the United States. Um, Transaction activity is just down as a whole.
Interesting how this forecast has it price per unit going much higher than the peak.
Yeah, not much of a dip from their peak either.
Yeah.
So it's less of a steep curve.
Which makes sense because I mean it wasn't a overheated market, right? It wasn't
Right,
not everybody was looking to buy in Columbus, Ohio like they were Dallas. So
right.
definitely makes sense.
And then this next slide points to what I was talking about, how the rent growth, it's stayed very steady, really only dipped roughly around 3%, and and it's forecasted to actually spike here in a bit. Um, so, I mean, this is one of the main reasons that we're looking at Midwest cities like Columbus. We've looked at a few deals in Columbus, haven't made anything work, but we're looking at a lot of Midwest cities that have similar, stories to the Columbus, where it wasn't overbuilt, but the population, um, and if you can make a good buy happen now in these cities, then you're going to be in a pretty good position, I think. And then the next slide, similar graph, construction activity starting to come down on a total unit basis. I mean, DFW's got 50,000 to 60,000 units delivered versus Columbus is only around 8 to 12 here. So major difference in total apartment numbers, but everything's trending down on the future supply front.
All right, that was a ton of awesome information. Thank Nick. I definitely want to applaud Nick for mostly putting that together. If you guys have any questions, if you guys want to go back to any slide, if we think you went over something a little bit too quickly, have any questions about what we went over, feel free to put those in the chat. Be happy to answer those. You know, we did go over quite a bit, so a lot to take in. Happy to answer any questions there.
Man, we usually have a ton of questions. We might have thrown too many numbers out there.
I know my mind is blown here too with that all that data. Maybe people, it's definitely drinking through a fire hose here on this data, but a lot of good stuff.
Yeah, I mean, I love the numbers. You know, it's so telling when you kind of look at it on a macro level, and then when you kind of dive deeper. So I like what Nick did there. You know, he kind of showed us some macro stuff, and then that's not necessarily as telling when you go into a micro market. You know, nationally, the rent growth might be flat or down, but then you find a Columbus or whatever market where the rent growth is still there. Still a lot of room for growth in price per unit. So um, definitely something that you know, that's why we're kind of always open to new markets and um, diving deep into the data and seeing um, kind of finding some of those sleeper markets.
Yeah, I think you made a really good point early on in this slide. Like, you know, when that bottom happens, it's already, you know, you don't really realize there was a bottom till after. And I think, you know, you have
100%. I mean, same thing happened to us after '08. Um, you know, Eric and myself, we kept buying properties, but it was harder to capitalize them and whatnot, and a lot of unknowns. And that was the first down cycle we had gone through. Um, but then I always look back, and it's like when you're in it, you don't quite notice that bottom. Um, and you know, I wish we would have made more efforts to. You know, back then we weren't uh, taking on investors like we are now and syndicating deals. But looking back, I wish I would have bought everything we would have touched, you know, everything we saw. So, you know, we're trying to capitalize on that this go around. Um, yeah, that's real estate cycles, man.
Yeah, and we mentioned it before in some of these past webinars. Is staying active is a great way to be tracking these cycles and seeing where stuff is trading, and you know, staying disciplined to your underwriting, no matter where you think you're at in the market cycle.
Okay, it looks like no questions are going to come in. Did you check Facebook as well?
Yeah, we had some just some on Facebook. It was more just
Just
some
comments.
comments. What are you guys looking at? Ground up construction rates was a question that came in right now. We're seeing ground up construction. We're seeing mostly banks pricing it off of Wall Street Journal Prime plus 100. So 8.5%, I would say, is fair to say for ground up construction. 8.5 to 9.5%, depending on the lender. I would say 65% leverage is on the high end, you know. Seeing a lot of banks right around 60 to 65% on the ground up construction. Around 8.5, 9.5%. Hard to make those deals pencil for exactly that reason.
All right. Guess we can wrap it up if we don't got any other questions coming in.
No, nothing else. Thanks so much for taking your time, putting this information. Very helpful. We appreciate you coming on. Hopefully we added some value this afternoon and we want to continue doing that.
Yep. Thank you all.
All right. See you guys.